think the biggest thing is that we have this new banking system that is not your father's banking system. And we have an idea of what a bank is. A bank is a big marble building with a sign in the window that says FDIC insured, right? And you go in and you get cash or you deposit cash. And those things still exist, more like shopping mall storefronts than big marble buildings, but they still are ordinary banks. But at this point, where most of what, at least on the eve of the crisis, most of the banking activity that was going on in this economy was things that didn't look like that. They were things that actually had no storefront, certainly no big marble building. They were things like asset-backed commercial paper funds, or money market funds, or auction rate securities. All of these institutions that were for, they were giving people what they thought was a way to park their cash with ready access to it, but they were paying higher interest rates than banks paid, and in return they were then lending that money out, and it looked like banks to people, except that turned out they weren't as safe as banks. They weren't regulated. They didn't have a safety net. They certainly didn't have insurance, and this thing, which people call the shadow banking system or the parallel banking system, was on the eve of the crisis. It was bigger than the conventional banking system, and it's now imploded. It's just basically shriveled up, and that was what we didn't understand. I mean, there were hints of it, but no one, I think, until the crisis hit, realized just how big this was and how fragile it was. It's not that easy because these things are not that visible. So, there are a lot of money market funds. People probably have some money market funds in mind. Many people have money in money market funds. I guess I have some in, what is an A.G. Edwards money market fund, which is now thankfully insured because the Fed moved in to rescue it. But I think any money market fund was part of this. Asset-backed, or actually auction rate securities, which is a classic, because that was a $350 billion bank in effect that wasn't called a bank. Those were mostly set up by banks you've heard of. They were set up by Citibank or in some cases by the investment banks, but typically they were set up by Citigroup or J.P. Morgan, but they were not guaranteed by them. It wasn't part of the regular thing, and so people had these money in these institutions, these arrangements, and didn't realize what they were actually getting into. It's a lack of obvious brand names, and that's part of the problem.